The Liberal government has announced the boldest mortgage reform in decades. And when this announcement first came out, we did a quick video on what exactly was announced. But since that video, we have received much more information on how things are looking like they will actually play out and some new rules that did come in at the same time. I'm Michael Ouzas. I'm a realtor here in Toronto. If you ever want to book in a call to discuss how these mortgage rules will affect you, whether you're a step-up buyer, a first-time buyer, or a property owner looking to renew your mortgage, you can click on that first link in the description down below. Back in the middle of September, the Liberal government made quite a big shock to the mortgage world when they announced a couple new rules, which we broke down in a past video. Among those rules was the new down payment structure where you no longer need to have 20% down over $1 million. That number is now at 1.5 million. If you're also a first-time buyer and you are getting an insured mortgage, so insured is anything less than 20% down, you can also qualify for a 30-year amortization mortgage. On the pre-construction side, any buyer who is looking to purchase for them to move into in a few years can also qualify for that 30-year amortization mortgage, which they couldn't in the past. And the last rule that was announced was that if you have a mortgage coming up and you are considering maybe changing lenders or shopping around that rate to another bank, you do not have to get stress tested by that other lender, which is a huge factor when it comes into play when qualifying for a new mortgage, especially at today's rates. Let's break down each one by one, because we did get a lot more information since the first announcement back on September the 16th. They are calling it the most ambitious housing plan in Canadian history. And keep in mind, there are talks of an election here in Canada. And anytime we get talks of an election, housing is always at the forefront. It was the same thing a few years ago when they had their last election. Same thing going on right now. And this is a bit of a surprise move, but I do feel like there is an element where the election comes into play here. This talks about where Canadians can get ahead, where their hard work pays off, and where they can buy a home. On September 16th, they expanded eligibility for 30-year amortizations for insured mortgages to all first-time buyers and all purchases of new builds or new construction properties, increasing the $1 million price cap for insured mortgages, which is that 20% down, and those will be in effect on December the 15th. And they now released parameters for the lender's insurance. And on September 2024, they actually released the parameters for lenders and insurers to begin offering mortgages under these new reforms, which starts on December 15th, 2024. Let's talk through these parameters one by one. And there is another video talking to our in-house mortgage broker, Tom Yosevich, which breaks down these details in more plain language as well. First up, expanding eligibility for 30-year mortgage amortization. And what that means is that if you have a 25-year amortization, if you pay the same payment every single month at the same interest rate, it would take you 25 years to pay off that mortgage. 30-year amortization would take you 30 years to pay off that mortgage. Now, this is for all first-time buyers and buyers of new build or pre-construction properties. Now, this mentions that the total loan value is 80% or more, so it doesn't have to be at that 20%, which it used to be for the down payment to qualify for 30-year amortizations. Now you can get that same qualification if you are less than 20% down, and the borrower is either a first-time home buyer or purchasing a newly constructed home. To consider being a first-time home buyer, a borrower must meet one of the following criteria: never purchased a home before. In the last 4 years, borrower has not occupied a home as a principal residence that either they themselves or their current spouse or common law partner has owned. Borrower recently experienced the breakdown of a marriage common law partnership. On this point, regulations will follow the approach that CRA has taken with respect to the home buyers plan. The next piece of this on the newly constructed home must not have been previously occupied for residential purposes. Requirement is not intended to exclude newly constructed condominiums, whereas there has been interim occupancy period. Now, this is where things are going to get interesting, where it talks about increasing the $1 million price cap for insured mortgages up to $1.5 million. And this measure would apply to all borrowers requiring high loan-to-value mortgage insurance in Canada and must satisfy the following requirements: 80% or more total loan-to-value, so less than 20% down. The value of eligible residential property against which the loan is secured must be less than $1.5 million. The down payment requirements for the loan are as followed: 5% on the portion of a purchase price up to $500,000 and 10% on the portion of a purchase price between $500,000 and $1.5 million. And these get added together. So if you are purchasing a property, for example, for $1.5 million, it's 5% of the first $500,000, which is $25,000, and 10% on the next million, which is another $100,000. So your minimum down payment on 1.5 would be $125,000. That's a huge difference from where it was was, or where it currently is up until December 15th, which the minimum down payment as of today is $300,000. We're almost looking at about half the down payment. There's a big thing here, and I do feel that this will impact the market here in the city of Toronto. The $1 million threshold is typically the tipping point where you go from condo into either a townhome or start to get into some freehold properties in and around the outside or outskirts of the city. That $1 million mark, typically the challenge for most people is you go from $999,999, which is a down payment of about $100,000 versus the down payment required at that $1 million mark. So only $1 more was $200,000. So essentially doubles. With the new rule, it will take off some of the limitations for some buyers who maybe don't quite have the down payment, but do have the income that could support a mortgage of maybe 1.2 or 1.3 million, for example, compared to the down payment that they require today. That's going to be a major factor moving forward. And I don't believe we're going to feel it as of yet, as the new rule here does mention that this comes in on December 15th. Lenders aren't able to submit them until after December 15th. So if you are looking to purchase today with, for example, a 90 or 100-day closing, what could be a factor there is that if your lender cannot put in the application until December 15th, you need to make sure that they have enough time to get that approval in if there's a closing after December 15th. It is a bit of a gamble in that sense, and maybe the recommendation would be to only go this route if you do have that 20% down payment available, because that way, if the rules change or if they don't go through fully, or if anything in this announcement does change between now and December 15th, you're not counting on only being able to put down that minimum or that new minimum down payment once that rule comes into place. So definitely trend with caution there. And if you aren't sure or have any reservations upon this, it'd be recommended not to make that purchase until after December the 15th, until all these rules are fully into play and you know that you can move forward with the minimum down payment on the property you're looking for. These measures will apply only to high loan value mortgages on properties occupied by the borrower or a close relative, and all the other criteria for government guaranteed mortgage insurance will continue to apply. The next piece of that is that if you are looking to put down less than the 20%, there is an amount of mortgage insurance premium that will get added to your mortgage balance. So for example, if you are purchasing for $1.5 million and your old down payment was $300,000, your mortgage balance would be $1,200,000. Under the new rule, if you're putting down that $125,000 as mentioned, there is a mortgage insurance premium that will get added to that mortgage balance. That premium is tiered, so this is something to discuss with your mortgage broker of exactly how much that cost would be added to the mortgage premium balance. We are hearing that is in the $50,000 to $60,000 range, which gets added to your mortgage balance. So if you're buying for $1.5 million and you're putting down, let's say $125,000, instead of having a mortgage balance of $1,375,000, that new balance may be somewhere in the 1.425, 1.43 or 435 type of thing. So something to discuss with your mortgage broker. That being said, it may allow you to qualify for that home quicker, although there is that premium that will be added to the balance. That's up for you to have that discussion and decide what is right for you, if you're better off saving the difference over a longer period of time, or if getting into the market sooner you feel is a better option for you. The last piece of this, which was announced, and this is actually coming into play in November, is that if you are considering changing lenders when you come to your mortgage renewal, you can actually do so without having to re-stress test. And that's a huge factor, especially when it comes to those renewing their mortgages in the end of 2024, going into 2025. Now you can actually shop around your mortgage to other lenders and see if you can get a better rate elsewhere. Sometimes the lender that you're with may try and take advantage that you've already qualified with them and will continue moving forward with them, and they might not give you the most competitive rate. I'd strongly recommend to push back on the initial rate that they give you and see if you can discuss with one of the specialists to try and give you a better rate. Going to other lenders to see if they have better rates will also help you in a negotiation with your current lender. So if you had a great experience with your lender so far, try shopping that rate around and getting a better rate from them. Or if you haven't had a great experience with the lender that you've been with for the last few years, in November will be your time that you can shop around that mortgage to other lenders to see if you can get a better rate and maybe some better service along the way. But one thing's for sure is it does pay to shop around, and strongly recommend doing so. The other element is you could put down more a lump sum when it comes to the next renewal point. So that's something also to discuss with your lender on what your lump sum payments will look like to try and help maybe a difference in mortgage rate as we move forward. Although we have been seeing mortgage rates come down, and there are a couple other Bank of Announcement rates also coming. So the variable side may also be getting some kind of relief moving forward as well. Love to hear your thoughts in the comments down below on what you think is of these new rules and how they affect you as a first-time buyer, a step-up buyer, or a home seller. I'm Michael Ouzas. Thanks for watching.